We've heard on this podcast previously how container lines and logistics companies are now making serious plans for this shift in cargo away from China. This is related to post-COVID lockdowns, the war in Ukraine, threats to Taiwan, changes in that geopolitical landscape. And of course, we've got higher US tariffs going back to the Trump days. So producers really are now looking at non-China alternatives. Can you explain a little bit about how moving production to a new location, let's say South Asia or Southeast Asia, how does this add complexity to supply chain operations? And also, what advice would you give to a company looking to do this in terms of the challenges they will face?
Mike, very relevant line of inquiry. We're dealing with clients almost every day who are looking to diversify, the geography of their supply locations. But I think it's important to yes, acknowledge that there is a decoupling from China, but there's other things happening around the world which are sort of driving all of this. So I think the big one that we see and that we've been dealing with, in fact, in this region, Southeast Asia region, for a while, is the changing demographics. So you've got a growing middle class emerging in various countries. Indonesia, the middle class is going to be huge. They're going to have tremendous spending power. Now, yes, Indonesia is definitely going to benefit from the China sort of +1 or +2 or +12, whichever it is, strategy. But Indonesia in its own right needs additional investment in logistics. And that it's been forthcoming, but it's been forthcoming very, very slowly. There are new ports being built. The airport is getting some investment, but it's still not going to be sufficient to meet the needs of that growing sort of middle class and beyond. So Indonesia is the largest economy in Southeast Asia. And yes, it's going to benefit from the decoupling aspect. It needs more infrastructure, and that's right across the archipelago. And I think it's something that you'll probably be familiar with, having lived there yourself, is that there is infrastructure. It's creaking, but then there's also the issues around that infrastructure. So just taking that particular country as a case in point, and you can draw sort of parallels with the Philippines and Vietnam here. Having the port infrastructure in place is one thing. Having government departments that have got the know-how to smooth the way for businesses to flourish, being able to issue licenses, being able to get out of the way when infrastructure is going in there, when money is made available, rather than being a sort of unnecessary gatekeeper. Those are critical things, and it's still something which is quite slow in coming around the region. I think as far as the other reasons driving the diversification of supply, you've also got more free trade agreements in place. So people are more willing to look at manufacturing or selling into certain markets. So yeah, the China thing is very real. Mexico and Vietnam, I think, are the two most immediate beneficiaries, perhaps Bangladesh with the garment trade to a lesser degree. But the decoupling from China is a very, very long-term project compared to the speed with which carriers can, for example, switch on and switch off services. So in order to, for example, replace a semiconductor plant that's been churning out products very, very smoothly and consistently in China, that's going to take 3 to 5 years to replace in even a well-developed economy such as Singapore or Malaysia. So there are issues with the whole decoupling thing, but there are other drivers beyond that decoupling which are going to drive this diversification. And the carriers are coming. We're seeing flexing of shipping services. We're seeing more investment in freighter services, more investment in airlines around the region. So yeah, I think that the physical part is probably the easier part to deal with. I think that's been consistent over the years.